All right, everyone, we're looking at a Dow that's up 204 points right now. Investors really shaking off all those escalating trade tensions with the U.S. and China. China's refusing to back down. Some analysts say the country is running out of options altogether. And time is kind of running out for the U.S. and Canada to reach some kind of NAFTA deal as well. So I want to bring in right now Dennis Gartman, publisher and editor of the Gartman Letter, and Jack McIntyre, portfolio manager for Brandywine Global. Jack, starting with you, where do you see this heading? I mean, obviously the market seems to think it's all okay.
Yeah, it is okay for now. I mean, when you look at global trade, it's actually doing fairly well right now. So the real economy is doing better. It's always about the uncertainty of where this escalates. We have to make some type of assumption as a money manager. We're going to make that assumption that we're not going to escalate into a full-blown trade war. We're going to see cooler heads prevail. That might not be today or next week, but at some point. And then the economies can kind of focus back on their more positive trajectory.
Mm-hmm. You know, let me go over to your counterpart here, who has not been entirely optimistic throughout this. So you've been missing a lot of the upside, shall we say, in this market, as you've been fairly bearish, Dennis. Are you continuing that theme here? Are you worried about trade so much that it causes you to worry about these markets?
It causes me to stay upon the sidelines more than it does anything else. And let's not get too excited. The Dow is indeed up 205 points as we talk. But isn't it interesting that the NASDAQ is down on the day? In the old days, we used to call that painting the tape. It was a way to get people to be excited about the market. It is still a bull market. I understand that. It has been a bull market. It will continue to be a bull market until it stops. But am I excited about it? No, not really. Am I doing okay in it? Yeah, I'm up. You know, I'm up for the past several months, but I'm not going to throw in and say, gee, it is absolutely a full-blown sky to the limit type of bull move, especially with the NASDAQ.
Was it, for example,
not making new highs?
Was it, say, after the election back in 2016, when everybody was worried that, you know, all HELL was going to break loose because somehow the president managed to win? Was that when you first started buying? Because I mean, it's been like almost a straight arrow up since then, Dennis.
It has been. Let's be blunt. And did I miss some of it? Of course. I'll be honest and say that I didn't buy into it as strongly as other people had. I've consistently said it's a bull market, but again, did I throw in and say it's going to the sky and should I buy everything and just throw all caution to the wind? No, and I have not, and nor shall I in the future.
You know, Doug, one of the big complaints over the last several decades has been wages, right? Wages just haven't increased, and now we're starting to get evidence that they're going up. And by the way, that employers are offering other kinds of benefits, perhaps before they get to the wage increase, to try and entice people. There's a Wall Street Journal piece on that today. Are we starting to see real evidence of a massive turn in terms of wage growth? Because that's something that has been so stagnant, really, for so long. Will that change this year? Mr. McIntyre?
Oh, I'm sorry. So labor is certainly improved. They're not in full control. I think companies are going to be in a position where they can't necessarily pass on higher wages. So the idea here is that wages automatically equal higher inflation. I think that relationship is sort of broken down because we have such an extreme competitive environment. Companies can't just naturally pass on all higher input cost. And at some point, the risk is that as wages move higher, well, companies are going to increase more in automation, and then that's going to give sort of labor, push them back into where they've been for the last couple of decades.
Dennis, how are you thinking about the labor situation right now, right? Because, I mean, it's typically the whole mantra, you know, in any Econ 101 class would be free trade is good, and that it lifts all boats, and that we will be better off. But as we've looked at what has happened to labor, as we've gone about that path, it hasn't been a good situation for American labor. And people have been fighting back, and now this president's fighting back with the prospect of all these tariffs. What happens to labor?
Well, I mean, first of all, let's be blunt. Things have gotten much better for labor in the course of the past year and a half. we have more jobs available than we have people working or needing them. That's a good sign. And there's no question, around here, every place I travel in Southeast Virginia, there are help wanted signs everywhere. There is a real shortage of labor, and labor rates are going to go higher, wage rates are going to go higher. That's a given. It has to happen, and it shall happen. And what the problem shall be for corporations is that they won't be able, as the other gentleman suggested, will not be able to pass that on to the consumers. And so the profit margins are going to be narrowed over the course of the next several years. Labor is in a much stronger position than they've been in a very, very long while, and that's likely to continue for a while longer.
Jack, so what are you thinking? We're going to keep moving up? Economy's going to keep getting better? Is there anything in the way?
Oh yeah, there's plenty of things potentially in the way.
No, but all right, seriously in the way, because potentials, anything can happen in the world of potentials.
But I go back to the yield. Yeah, the yield curve in the U.S. I mean, what is that telling us? Is it telling us, hey, the Fed doesn't need to be overly aggressive in tightening? So I'm in the camp. I think they will listen to the low inflation story embedded in the yield curve. Hey, I think the best opportunity, and it's been a very bumpy ride this year, is not in the U.S. It's in the emerging markets. Be selective. Those are the ones that have gotten beaten up. I'm not sure I want to buy U.S. equities powering ahead near all-time highs.